pay yourself first. Now, this is really important because it actually allows you to, first of all, build up that emergency cash fund that you need, because I'm not a fan of investment-linked plans, or ILPs as they're known in the marketplace, because these marry the insurance component with the investing component. Okay, so before I get started, if you do want more content like this for practical advice and actionable insights, then do hit the subscribe button. So something I hear a lot from people on their investing journey is, how exactly do I even start investing? This is a perennial issue because maybe you don't know which investment to go for. You're not sure about your financial setup and how much money you have to spare to invest. There are lots of different issues for people who are just starting to invest. So I'm going to try and cover in this video the first 5 steps that you should take before you start investing in Singapore. Let's get stuck in. Number 1, buy protection or buy insurance. Now, this is really important because if you are investing and you're putting your money into stock markets or equities, and then suddenly you need cash, and unfortunately, maybe the market is down, you're going to have to sell at a loss. But more important than that, insurance really provides that safety net for you. So hopefully you'll never have to really use it. So when I talk about buying insurance, I'm obviously talking about buying term insurance, because I'm not a fan of investment-linked plans, or ILPs as they're known in the marketplace, because these marry the insurance component with the investing component. And unfortunately, 99% of the time, you get the worst of both worlds, I would say. You get high fees on the investing side, and really you just don't get enough coverage on the insurance side. Now, one of the best sources for independent advice and education, I'd say, on insurance for people in Singapore is Money Owl. Now, this used to be an advisory service. It got taken over by Temasek Trust. And really, they provide some really good independent advice and insights into the type of term insurance that you might actually need to get, and the best protection you can get for the lowest cost possible. So if you go onto their website, go to Owl Insure and kind of look around, see some of the articles they have, maybe download their insurance philosophy ebook, and just read up and really educate yourself about the type of insurance that you'll want, because some people will prefer to have a higher premium for more coverage, perhaps on their healthcare, or a higher premium for life. So I think it depends on your situation, your family, your own personal desires as well for the coverage that you're getting. So really go out there, do the research, understand it. It will be a very individual decision. But for me, buying term insurance is really the best way to start out. Number 2, build up an emergency fund. Now, what does this mean? Well, as the name suggests, it's for emergencies. So you're aiming to build up a cash hoard that can hopefully tide you over if there is an emergency. And what does that mean in terms of an emergency? Well, that means something like losing your job, perhaps, where it might take anywhere from 6 months to a year to find a new job. It might be a medical emergency for yourself or a family member where insurance coverage doesn't cover the whole portion of it, and you might have to shell out from your own pocket to cover that. So these kinds of emergencies can actually set you back financially. So ideally, you should have around 3 to 6 months of your day-to-day expenses in a cash account, or in cash, liquid cash. Now, this is relatively low, I personally think. And nowadays, with the job market being a little less certain than it used to be, some people are saying that 6 months is the minimum. And if you want to be a lot more conservative, then 12 months could be something to consider in terms of your cash, emergency cash. Now, it means day-to-day living expenses. So the bare necessities. This isn't 12 months of cash like you going on holiday, you eating out, dining out. This is the day-to-day living expenses. So really the bare minimum. Number 3, pay yourself first. Now, this is really important because it actually allows you to, first of all, build up that emergency cash fund that you need to. And then second, it also will allow you to invest when you get to that point too. Now, what do I mean by pay yourself first? Well, basically, when you get paid your salary, what you should do is put away some money from your salary straight away into savings, or to pay your insurance, or whatever it is, so that that money is then put away and you know that you're going to be saving something. And then after that, you are going to meet your must pay bills. And obviously, lastly, will be discretionary expenses where you go out and eat or you travel. Now, this is the reverse of spending first and then figuring out that maybe you will save something, maybe you won't later. So the reverse is basically paying your bills and lifestyle expenses first, and then whatever's left over, trying to save. And so that becomes really difficult if you do it in that order. So first order is the best. So paying yourself first is a really important step to first off building up your emergency fund, but then later investing on a regular basis. Number 4, figure out your risk appetite and learn more about stock markets. Now, this is a really important point because before you get started in investing, you kind of need to determine what type of investor you are because everybody is going to be very different in the way that they invest or the types of instruments or assets that they invest into. And why is this? Well, basically, it's based upon your appetite for risk or how much volatility you can stomach in the market. However, you do need to realize that if you take less risk, you will likely be getting less return. And if you take on more risk, then you will likely be getting more return. So this is the whole basis or the foundation of investing. So beyond that, you should really also be educating yourself about the stock markets, about asset classes that are out there, like bonds, like maybe alternatives such as gold, and just understanding what they offer to investors because it's important to understand the market data to really think about how markets have reacted in the past with big declines, how markets have reacted in the past with big swings up, because a lot of it will become psychological when you start investing. So, understanding the data, understanding the history of markets, that will make you feel a lot more at ease when you do start investing into either the stock market or into the bond market or into whatever financial market. You're going to understand it a lot better. And you don't have to be a financial whiz kid or someone who has a PhD in economics to really go out there and just understand how markets behave. I think a basic understanding of maths is useful, obviously, to understand yields and to understand returns. But returns on an annualized basis is something everyone can grasp. So if you can go out there, try to brush up on what type of returns are due to you as an investor in certain types of markets, then I think you're going to get a better idea of what you can aim for when you do start investing properly. And finally, number 5, start investing with exchange traded funds or ETFs. Now, ETFs have become extremely popular over the past 10 or 15 years, and there's good reason for that. They are very, very low cost. They give you broad and diversified access to global stock markets, global bond markets, global financial markets, any type of asset that you want. But the big positive to them is that they are diversified. Because I think for most investors who start out, maybe they start buying individual stocks. Individual stocks are extremely volatile or can be extremely volatile. They can go up a lot, but they can also crash 80, 90% and never recover. So understanding how the market works at the base level, really getting comfortable with that first is a great idea. And ETFs provide one of the best ways to do that. So if you are looking at ETFs, go with reputable big providers that you have heard of, such as iShares, which is owned by BlackRock, or Vanguard, or State Street, which runs the Spider series of ETFs. And these guys have a lot of scale. They have very low cost ETFs, and they can give you access to global equities, US stocks, European markets, Asian markets, all types of different asset classes and markets. So I think for investors who are really just starting out on their investing journey, starting with ETFs is a great place to start. If you do have an interest in companies, in stocks, then from there you can build that core and then you can go explore whether you want to buy individual stocks. But for investors who are starting out, the best is really to get the market average, understand how the market works, get comfortable with that, and then from there, choose if you want to go any further along the curve in terms of buying stocks and other individual investments. So there you have it. Those are the first 5 things I think you should have covered before you start investing in Singapore. Number 1, have sufficient protection or insurance. Number 2, really have an emergency fund of at least 3 to 6 months, if not longer. Number 3, have the ability to pay yourself first on a monthly basis. 4, really understand your risk appetite and market history and try to get comfortable with that. And then finally, 5, start your investing journey with exchange traded funds or ETFs. Now, if you do those 5 things, I think you will have a great foundation to go on and be successful over the longer term with your investing journey. If you do want more personal finance insights, money tips, and actionable advice, then please do hit the subscribe button here and give me a follow.